Hello, I'm John AG. There's a moment that happens in every market cycle where denial quietly gives way to discomfort. It's not loud. It doesn't come with a breaking news banner. It arrives as a feeling, the sense that explanations are starting to sound thinner than the evidence on the screen. That's where we are now. For years, people were told the dollar was unshakable, that debt was manageable, that gold and silver only moved on fear or speculation. And yet, those metals are behaving like they're reacting to something deeper, something structural, something that doesn't need panic to exist. This is not about collapse, it's about pressure, and pressure doesn't announce itself all at once. It builds quietly, then shows up in places most people aren't watching. Precious metals are one of those places. They don't respond to speeches, they respond to incentives, confidence, and trust. When those inputs shift, price adjusts long before consensus catches up. To understand what's happening, we have to correct a common misunderstanding. Currencies don't move based on absolute strength, they move based on relative change. It's not about who is healthiest, it's about who is deteriorating faster. If the United States weakens at the margin more quickly than other major economies, the dollar can lose ground even if the rest of the world is struggling too. Markets price momentum, not moral standing. Picture two systems running side by side. One has always been dominant, the other is flawed, slower, and visibly strained, but then the dominant system starts absorbing new stress. Not a crisis, just added weight. The second system doesn't improve, but the gap begins to close anyway. That's how currency shifts unfold. Quietly, incrementally, until they aren't quiet anymore. Right now, the dollar is being squeezed by three overlapping forces. The first is expectations around interest rates. Markets don't wait for policy decisions to be announced. They price what they believe is inevitable. When traders begin to assume that easier monetary conditions are ahead, yield support weakens. Yield has been one of the dollar's strongest anchors. When that anchor loosens, capital becomes more mobile. The second force is funding. The scale of U.S. debt refinancing is enormous and ongoing. Rolling that debt requires constant participation from buyers. When those buyers start asking tougher questions or demanding better compensation, the system must respond. It can either offer higher yields or allow the currency to absorb part of the adjustment. Historically, the path of least resistance is currency softness. It spreads pressure across the economy instead of concentrating it in rates. The third force is confidence. The dollar benefits from a trust premium built over decades. Investors believed the framework was predictable, disciplined, and resilient. Confidence doesn't vanish suddenly, it erodes. Questions about fiscal direction, policy consistency, and crisis management don't need answers to cause damage. The act of questioning alone trims the premium. And when the premium shrinks, the currency becomes more vulnerable. This isn't a forecast of disaster, it's a reading of stress levels. When stress rises, gold and silver tend to respond early. That's not mythology, it's historical behavior. Metals react to changes in trust, not official reassurances. There's also a human element that rarely gets acknowledged. People are tired of narratives that reverse themselves. Inflation was temporary, then persistent, then resolved. Debt didn't matter until it suddenly did. Each revision weakens credibility. Over time, the benefit of the doubt disappears. That's when small, technical moves stop being dismissed and start being respected. This is why context matters. History isn't useful because it repeats exactly. It's useful because patterns emerge. And the pattern unfolding now looks familiar to anyone who has studied prior currency adjustment cycles. Previously, I explained a simple principle. Precious metals don't usually form lasting tops until the dollar forms a lasting bottom. Not a brief dip, not a one-day scare, a breakdown that changes behavior. For months, one level on the dollar index dominated market psychology, the area around 96. Each test reinforced belief. Each bounce restored confidence, until recently. When the dollar slipped beneath that level intraday, the reaction wasn't dramatic, but it was revealing. The bounce lacked energy. The recovery felt forced. Price action looked tired. That matters. Markets can tolerate weakness. They struggle with fatigue. The dollar doesn't need to collapse for metals to surge. It only needs to lose credibility gradually. Slow erosion is dangerous because it feels manageable. People insist it's temporary, right up until they stop insisting. Recent data shows pressure appearing across multiple fronts at the same time. Debt issuance, rate expectations, capital flows that move independently of rhetoric. Markets respond to incentives, not reassurance. When incentives shift, behavior follows. So here's the framework for what comes next. First, we need to look at how gold and silver behaved the last time the dollar weakened from this zone in a sustained way. Second, we need to examine what lies beneath the next major support level, because that's where psychology changes. Third, we need to address the question that always surfaces when silver accelerates. Do you focus on the metal itself, or do you look toward mining equities that promise leverage but carry risk? Before going further, we need to confront the math, remove politics, remove emotion. Federal debt is now well above $38 trillion and continues to expand. Combine that with refinancing needs and interest costs, and the system becomes highly sensitive to shifts in sentiment. When markets hear that policy easing is likely, that message doesn't stay confined to rates. It flows directly into currency valuation. Some listeners interpret recent central bank communication as confirmation that cuts are coming. Others hear something else entirely. They hear constraint. They hear limited options. That perception matters. When investors believe policymakers are boxed in, they tend to seek protection rather than yield. At the same time, global capital is rotating quietly. Fund flows tell part of the story. The dollar's inability to sustain rallies tells another. Gold being aggressively bought on pullbacks tells a third. Silver's behavior ties it together. It's acting like a market facing tight supply and rising urgency. Silver's move above $100, followed by a surge past 117 and a sharp reversal, triggered emotional responses across the spectrum. Optimism spiked, skepticism hardened, but the important question remains unchanged. What is the underlying trend? Gold and the dollar index have moved inversely across decades often enough to matter. Not perfectly, not continuously, but reliably when confidence shifts. When the dollar rolls over, metals rarely wait for confirmation. To understand where this may lead, we have to revisit the last clean example of a dollar breakdown from this zone. What made that episode powerful wasn't just the chart, it was the policy environment. Emergency measures, massive liquidity, a rapid shift from restraint to accommodation. The outcome was predictable. More currency units chasing the same tangible assets. Gold reacted first, establishing new highs. Silver followed later, accelerating sharply once positioning changed. The lesson wasn't about the first move, it was about what happened after. Gains expanded once the market stopped expecting an immediate recovery in the dollar. That's why the recent slip below 96 matters. Initial moves attract attention. Continuation changes portfolios. Silver pausing and then surging again often reflects forced adjustment, not exhaustion. And that brings us to the edge of the next phase, because the real question isn't whether the dollar weakens further. It's what happens if the next support fails. That's when narratives change. That's when hedging behavior shifts. And that's where the story truly begins. To understand why the next phase matters so much, you have to focus on behavior rather than headlines. When the dollar index weakened from similar levels in the past, the process wasn't dramatic at first. There were recoveries, there were confident statements, there were stretches where the market convinced itself the danger had passed. But underneath those surface moves, something important was happening. The market was slowly becoming comfortable pricing the dollar lower for longer. That acceptance, not the initial decline, is what fuels sustained moves in gold and silver. During that prior period, gold didn't drift upward casually. It stepped higher with purpose. Silver didn't creep forward cautiously. It surged, corrected, then surged again. The defining feature wasn't volatility. It was persistence. Once participants stopped expecting a rapid dollar rebound, capital began reallocating with greater conviction. That's when metals stopped behaving like short-term trades and started behaving like long-term trends. History doesn't copy itself perfectly, but it often echoes. If the dollar index were to follow a similar path from the current region down toward 90, the implications for metals are grounded in arithmetic, not fantasy. Even a modest percentage move in gold during a prolonged dollar slide produces prices that sound extreme only to those who haven't updated their reference points. Silver, because of its smaller size and thinner liquidity, tends to amplify those moves in dramatic fashion. This is where psychology shifts. 90 on the dollar index is not just another number. Above it, weakness can be dismissed as noise. Below it, explanations change. Hedging increases, confidence thins. Once that line is crossed, the conversation moves away from temporary softness and towards structural adjustment. To fully appreciate the stakes, you have to widen the lens. This isn't a story confined to the United States. Other major currencies are struggling with parallel versions of the same dilemma. In the euro area, a single currency covers economies with very different fiscal realities. Some members can tolerate higher borrowing costs, others cannot. When rates rise unevenly, stress emerges in sovereign spreads. Emergency language follows. Investors take note. Fragmentation risk doesn't need to explode to influence behavior. It only needs to feel plausible. The United Kingdom offers another illustration. Strong institutions and deep capital markets do not shield a currency from discipline. When fiscal ambition collides with bond market reality, adjustments can be swift and painful. The pound has experienced moments where it behaved more like a stressed currency than a stable one. Those moments leave scars. Confidence, once shaken, takes time to rebuild. Japan represents a different but equally important case. Enormous debt, Challenging demographics and years of extraordinary monetary accommodation have created a structure that depends on contained yields. When yields move, even modestly, global capital has to reconsider carry trades built on near-zero returns. That reconsideration ripples outward. The yen becomes a focal point. Portfolios adjust across borders. The purpose of examining these currencies is not to declare them failures. It's to highlight that the global system lacks a painless alternative. When several major currencies experience strain simultaneously, capital doesn't simply rotate to the least troubled paper. It looks for assets outside the paper system. That's where gold has always resided, and that's why silver is beginning to behave as if it belongs there too. This introduces a second, more subtle inflection point. When monetary demand for metals rises at the same time, industrial demand remains strong, pressure compounds. These are distinct buyer groups with different motivations, but they draw from the same supply. When that overlap occurs, markets can shift rapidly from feeling balanced to feeling tight. If the dollar index were to slip into the high 80s, daily life wouldn't grind to a halt. Transactions would continue, salaries would be paid, but something would change at the margin. Trust would decline slightly, hedging would increase incrementally. Over time, those small shifts accumulate. If the dollar were then to revisit levels seen in the early 2010s, it wouldn't signal collapse. It would signal repricing. Assets measured in dollars would need to adjust upward to compensate. It's important to avoid jumping straight to dramatic conclusions. Currency stress rarely begins with visible force. It begins with incentives. Policymakers favor choices that minimize immediate pain. Investors respond to perceived instability by demanding compensation or seeking alternatives. When bond buyers hesitate, funding doesn't stop. It adapts. Gradually, monetary expansion fills the gap. In many economies that have experienced prolonged currency weakness, early stages look deceptively normal. Businesses operate, restaurants are busy, life appears unchanged. Beneath the surface, however, purchasing power erodes. Savings lose value quietly. That's how confidence breaks, not through spectacle, but through math. When trust fades, people don't stop using money. They look for substitutes. Sometimes it's another currency, sometimes it's real assets, often it's a combination. Gold and silver don't require belief in future promises. They don't rely on policy continuity, they simply exist. That quality becomes valuable precisely when narratives feel unstable. This pattern isn't theoretical. In regions where currencies have lost significant value over time, precious metal ownership tends to rise organically, not out of ideology, but experience. Inflation ceases to be abstract when it touches everyday decisions. For observers in the United States, understanding this doesn't require predicting catastrophe, it requires recognizing direction. Debt continues to grow. Political incentives favor accommodation. Investors are questioning the appeal of long-duration paper with limited real return. Meanwhile, metals are already responding. Signals rarely become this visible without consequence. Another dimension deserves attention. Silver is not only a monetary metal, it is an industrial necessity. A substantial share of demand comes from real-world applications. Electronics, power infrastructure, renewable energy systems, and data-driven technology all rely on silver. This demand is structural, not speculative. Recent trends amplify this reality. Global electrification and automation are straining power grids. Data centers in particular consume enormous amounts of electricity. Building and maintaining them requires transformers, connectors, and cabling. Silver is embedded throughout that infrastructure. This is not a temporary cycle. It represents years of build-out. Silver's market structure intensifies these dynamics. Compared to gold, available inventories are smaller, liquidity is thinner. When demand increases, price doesn't rise smoothly. It jumps, retreats, then jumps again. Volatility is not an anomaly. It is a symptom of constrained supply meeting urgency. This explains why silver can move from calm to chaos quickly. It's not irrational, it's reactive. When multiple demand sources converge, equilibrium becomes difficult. The market expresses that difficulty through sharp moves. Above-ground inventories can absorb stress for a period, then suddenly they cannot. That transition often becomes obvious only after price has already adjusted. Volatility reflects uncertainty about how to price the future. This brings us closer to the practical question. Observing these forces is one thing, positioning for them is another. Watching markets is informative. Acting requires discipline. The question that keeps resurfacing is straightforward. Where do gold, silver, and related equities go from here, and how should risk be managed? The honest answer begins with humility. Directional conviction does not eliminate volatility, especially in silver. If the dollar continues to weaken, higher metal prices are a reasonable outcome. That does not mean the path will be smooth. Silver in particular tests patience. Emotional discipline becomes critical. Rather than focusing on precise targets, it's more useful to think in zones. Zones where behavior shifts. Zones where positioning changes. If the dollar continues lower, gold has room to reprice in ways that feel extreme only because mental anchors lag reality. Silver, because of its structure, can overshoot both optimism and skepticism. At the same time, an uncomfortable truth must be acknowledged. A weaker dollar does not guarantee metals rise in a straight line. In moments of sudden risk aversion, liquidity needs can force selling across assets. Even perceived safe havens can be sold temporarily. These episodes are rare, but they matter. That's why resilience matters more than bravado. Plans that assume uninterrupted gains often fail at the first shock. Plans that allow for turbulence tend to endure. This sets the stage for the final layer of the discussion, because leverage changes outcomes dramatically. And leverage, especially through mining equities, introduces opportunity alongside danger. That's where the story turns next. Leverage is where this discussion becomes both powerful and dangerous at the same time. Mining stocks are not the metal. They are businesses that happen to produce metal. That difference becomes critical when volatility rises. A bar of silver has no management team. It doesn't issue shares. It doesn't miss guidance. A mining company does all of those things, and that reality matters far more than most people acknowledge when prices start moving fast. The popular belief that miners automatically deliver 2 or 3 times the return of silver is not a law. Sometimes it happens. Sometimes it doesn't. There are long stretches where silver rises and miners lag badly. There are periods where costs increase faster than revenue. There are moments when dilution quietly erodes future upside even as spot prices climb. Leverage amplifies outcomes in both directions, and that amplification cuts deeper on the downside than many expect. The correct question is not whether miners will outperform silver. The correct question is which miners can survive volatility, maintain margins, and avoid destructive financial decisions while the cycle plays out. That requires discipline rather than excitement. It requires understanding balance sheets, not just charts. Owning only miners is not the same as owning metal. Metal is exposure to currency pressure and confidence erosion. Miners are exposure to execution risk layered on top of that pressure. Both have roles, but confusing them leads to disappointment. The metal has no boardroom. It doesn't negotiate labor contracts. It doesn't deal with permitting delays. It simply reflects purchasing power over time. Balance is what keeps portfolios alive through cycles. Physical metal acts as defense. It preserves optionality. Mining equities act as offense. They provide upside when conditions align. Too much offense leaves you fragile. Too much defense limits participation. The challenge is constructing exposure that can survive turbulence without sacrificing opportunity. Skepticism deserves a seat at the table here. Miners can remain undervalued for far longer than logic suggests. Cheap does not mean imminent. Markets can ignore fundamentals for extended periods. Catalysts matter, timing matters, and disappointment often arrives when enthusiasm peaks. Operational risks are routinely underestimated. Energy costs fluctuate. Labor markets tighten. Governments adjust tax regimes. Permits get delayed. Political environments shift. Share issuance happens at inconvenient times. None of these risks apply to the metal itself, but they dominate outcomes for miners. Geopolitics adds another layer. A project in a stable jurisdiction carries a different risk profile than one operating under unpredictable regulation. During periods of optimism, markets may ignore this difference. During stress, they price it instantly. Risk is rarely linear. Durability becomes the separating factor. Companies with strong balance sheets, manageable debt, and disciplined capital allocation tend to endure cycles better than those reliant on constant fundraising. Dilution is subtle. It doesn't cause immediate pain. It erodes long-term returns quietly. Identifying that early matters. Recently, silver prices have surged while many mining equities have failed to keep pace. This divergence can be interpreted in multiple ways. One explanation is disbelief. Investors may view the move as temporary. Another explanation is cost pressure. Rising inputs compress margins. A third explanation is positioning. Large pools of generalist capital have not fully entered the sector yet. When they do, repricing can be abrupt. Until then, valuations can remain depressed longer than expected. This environment rewards process over prediction. Emotional attachment to individual tickers clouds judgment. Commitment to a disciplined approach builds resilience. Balance sheets, cost structures, jurisdictional risk, and capital strategy matter more than enthusiasm. The dollar remains central to everything discussed here. The index has shown instability around the mid-90s. Each rebound has looked weaker. Each rally has been sold faster. This pattern doesn't guarantee collapse. It signals diminishing confidence. When former support fails to become support again, markets take notice. That's when levels like 90 stop being theoretical and start influencing behavior. If that level is tested, reaction matters more than commentary. How quickly buyers appear, how aggressively sellers press, how gold and silver respond. These interactions shape the next phase. When price diverges from official reassurance, markets listen to price. Gold and silver behave differently under pressure. Gold absorbs capital quietly because it is deep and liquid. Silver reacts violently because it is thin and constrained. That difference creates opportunity but demands emotional control. Silver tends to overshoot, pull back sharply, then overshoot again. Managing that rhythm matters more than guessing peaks. Physical holders experience this cycle differently than traders. Physical metal behaves like long-term savings. It doesn't require constant monitoring. Paper exposure requires discipline. Mining exposure requires vigilance. Understanding which role each plays prevents confusion when volatility increases. A practical framework helps. Decide what portion of exposure belongs in physical metal. That anchors stability. Decide how much risk can be allocated to miners without jeopardizing survivability. Diversify within that exposure. Plan exits in advance. Markets rarely announce turning points, but they do offer opportunities to reduce risk along the way. Chasing price after explosive moves often leads to regret. Building exposure during pullbacks rewards patience. Trimming risk during strength preserves gains. Remembering the original thesis prevents emotional decision-making. If the thesis is purchasing power protection during currency adjustment, short-term volatility becomes noise. If the thesis is quick profit, volatility becomes destructive. Silver's personality reinforces these lessons. It rewards patience and punishes impatience. Availability matters as much as price. Industrial users care about supply, not sentiment. When physical demand tightens, paper markets can behave unpredictably. Disconnects appear. Deliveries become the focus. The next phase depends on whether physical demand remains elevated as the dollar softens. Sustained overlap creates pressure. Alternatively, sharp volatility could flush weak positioning before continuation. Either outcome reflects a charged environment. Neutrality is unlikely. One factor often overlooked is real yield. Much of the dollar's strength in recent years has been supported by positive real returns. When holding cash preserves purchasing power, alternatives look less attractive. If rates fall while inflation remains sticky, real yields compress. When that happens, incentives flip. Guaranteed losses become visible. Capital seeks protection. Historically, periods of negative real yields have aligned with strong metal performance. Not because ideology changes, but because arithmetic does. Investors respond to math. This dynamic draws in participants who previously ignored metals. They are not joining a narrative. They are responding to incentives. That shift expands demand quietly before it becomes obvious. Preparation matters most before panic arrives. Execution matters when it does. The current environment sits between those phases. Evidence is accumulating. Denial persists. That combination has historically produced opportunity. Remaining patient, analytical, and disciplined provides an edge. Noise distracts. Process protects. Scenario thinking clarifies decisions. Risk should always be sized for survival, not excitement. One final point deserves emphasis. Currency systems rarely fail loudly at first. They adjust quietly. Confidence erodes slowly, then visibly. Metals do not predict collapse. They reflect repricing. Watching them closely offers insight into stress building beneath the surface. This discussion is for perspective and understanding. No single asset is a solution. No forecast is certainty. Recognizing incentives, behavior, and structure improves decision-making. The objective is not perfection. It is preparedness. When markets are calm, preparation feels unnecessary. When markets are chaotic, preparation feels impossible. The middle ground is where planning works. That is where we are now. Stay disciplined. Think in probabilities. Respect volatility. And remember that systems usually whisper before they shout. Listening early makes all the difference.